Good afternoon. Welcome to this Richmond PIMS Forum's last expert session on cryptocurrencies, a showcase on how to tame the beast. Let me quickly introduce myself. My name is Philippe Ramsebner. I'm the founding partner of Alpha Partners, which is a capital markets technology consulting boutique in Switzerland. But I'm today here in my function as the partner crypto investment strategies of Acture Capital, which is a Swiss-based hedge fund focusing on crypto assets. The interesting thing about the crypto space is it's the first time in my career that I have the feeling that I'm standing on the sidelines of something great to happen. It happened, for example, also with the invention of the internet. The interesting thing, if you speak to people about crypto assets or Bitcoin, you can see three dominating positions. The first one is Bitcoin is a fraud. Bitcoin is a Ponzi scheme. Bitcoin is just a bubble. Bitcoin will fail. The second position, those guys that have entered the market in 2016 and 2017, and they are bragging to you on how they leased their newest Lamborghini. Most of them most probably have given their Lamborghinis back already to the leasing company by now. And then there are those telling you Bitcoin is just a hype, but the underpinning technology, blockchain, will change the world. All those three positions have something in common. In my belief, they are fundamentally wrong. Black and white thinking stops you from discovering the true potential of the technology. I'm quite often getting asked the question, will Bitcoin survive? I want to guide you through my beliefs why I think Bitcoin will inevitably survive. But let's start with our design principles of money. As an economy, we started off doing barter deals, so we would exchange bananas against ham, goats against haircuts maybe. And then we realized that bananas make up for some shitty money, since it's quite heavy for the value it contains, and it might rot away if you're not fast enough in exchanging it. Then we started off with gold coins, then paper-based money, still backed by gold, and our nowadays fractional reserve banking system. All those sorts or forms of money have one common building principle. It's a 19th century central hierarchical structure that provides trust and value into the system. The question is now, what are the risks in having a central system? With trust comes power, and quite a lot of power. It's the power to include and the power to exclude out of the system for religion, race, skin color, or simply for the reason that you attained the wrong political event. This is happening every day on this planet. For example, India, if you have been unfortunate to have been born in the wrong caste, you simply don't get a bank account. The interesting thing is, in democracy, we designed our founding principles always with a decentralization of power. But in money terms, we are accepting that concentration of power, although money is such a crucial instrument in our everyday life. Throughout history, we have seen structural abuses of that power, may it be the LIBOR scandal, or may it be also hyperinflation in some countries, like Venezuela. We might agree that those kind of things don't matter in Switzerland or in a Western industrialized world, since who would actually think of cutting off the finances of WikiLeaks since they posted some compromising information about the United States? Nobody would. Or would we? The question is, how can we even create a monetary system without that central authority? We have many examples, for example, in democracy, where decentralization proved highly effective. In example, we are living in Switzerland, we are proud of the organization in the smallest unit, or our direct democracy. If it comes to financial investments, there's also some sort of decentralization, but we call it diversification. It's basically decentralizing the risk of one asset over our overall returns. If you're looking to the tech space, we can look at brokers. Brokers would bring a couple of years ago 4,000 to 5,000 contributors for that to contribute for the latest edition. Then Wikipedia came with hundreds of thousands of contributors. Looking at the mere number of articles posted on brokers, we are running on 300,000. Looking at the German edition of Wikipedia, we had 2.4 million. Not accounting for the English edition with 5.8 million. But it's not only the amount of information that is overwhelming, it's also the accuracy. Decentralized systems turn out to be highly effective. So the question is, why have we never managed to do it with money? To think about it, we first have to think about the value. What gives value to a currency? What gives value to money? It's basically a shared trust that I can exchange this banknote into goods and services. For example, if I'm going to a restaurant and I'm having dinner, I have basically two options. I can pay via cash or credit card. If I'm paying with cash, it's quite easy for the waiter. He puts out the banknote, holds it against the light. He sees the watermark and all the other security features. But if we are going to a credit card, we need intermediaries basically to prove if we really have the money on the account to pay for our dinner. Visa is quite good at it. If we are speaking of digital currencies, things are even worse. The term digital already means it's perfectly reproducible. If we are copying one Word document from one folder to the other, it's basically exactly the same copy, even to the last single bit. Therefore, as soon as we go digital, we create double spending problems. This problem has been articulated in computer science as the Byzantine generals problem and remained unresolved for multiple years. We can imagine a city surrounded by Byzantine generals. They want to take in the city, but they do know they have to attack together. But they can't hear and they can't see each other, so they have to rely on messengers, on horses that ride through the city. But therefore, they also can't trust the messages, since they might be tampered with when the messengers rode through the city. This problem remained unresolved until on January 9th in 2009, one person or a group of people, alias Satoshi Nakamoto, posted a piece of software and the documentation to it. What he did was something truly revolutionary. He has created the first open, decentralized, neutral, borderless, cryptographically secure, and tamper-resistant blockchain. The invention of Bitcoin was a direct reaction to the economic crisis of 2008, which also was made clear by Satoshi Nakamoto. He was the first one on a global scale that ever solved this double spending problem. just via math and cryptography. This triggered off a movement of an unprecedented scale. Just to give you an idea, the overall computational power of the Bitcoin network is 50 times the computational power of all Google servers worldwide. This is quite impressive. We can think of the invention of Bitcoin like what the internet did to communication. Bitcoin is, to that extent, the internet of money. And also interestingly, when the internet was invented, people spoke about the technology, TCP/IP. Everybody said the internet will fail, but TCP/IP will stay. People are saying the same thing today about blockchain. Then people argued about the internet, it's just for pornography, terrorists, drug trafficking. They are saying the same today about Bitcoin. But we don't see that money laundering happening. It's 1.7 billion that got laundered last year, which is to the overall market value of Bitcoin nothing more than it would be in a regular financial system. Then we started off with the internet with scalability problems. First, we could send emails, then we wanted to send attachments, and people said the internet will never be scalable enough to send attachments, until it happened. Then people complained we will never be able to do voice over IP over the internet, until it happened. Today, we can stream 4K ultra high definition video via the internet. I'm entirely sure also Bitcoin will have this 4K ultra high definition moment. But the question is, what does Bitcoin promise to us? It's the first time ever in history that a piece of technology enables the free flow of money to every place in the world, no matter if you have an ID, if you are of a black skin color or geography, it doesn't matter for Bitcoin. It's open. It's permissionless. It doesn't need to ask for permission from any government. It has the potential to include 1.7 billion people that are currently unbanked, according to last year's World Bank report. Since the only thing you need is a mobile phone. We have seen that although people might be unbanked, most of them have mobile phones. But it also has the potential to include those people that are living in hyperinflationary environments. For example, if you're looking to Venezuela, there is a real life use case. People in Venezuela are buying food with Bitcoin. It might not be worthwhile using Bitcoin as a payment method in Switzerland, since for us here, it's the Visa or American Express or MasterCard does a better job. But if you're living in Venezuela, Bitcoin is a viable option. And the interesting thing, what happens there, the government is pointing to the people, telling them, you are having the fake money. But the people from Venezuela can point back to their government and saying, no, you are having the fake money, since with mine I can buy food. For them, it also won't matter if it's forbidden to trade Bitcoin. Since as soon as it comes to feed your family, you don't care if something is forbidden or not. The Bitcoin network is also the most robust system we have ever built. It's out there in the internet since 10 years with not a millisecond of downtime. We don't know any enterprise system that can do that. But now let's quickly have a look on Bitcoin's disruption potential. What are the real world use cases? First, as I said, it has the possibility to bank the and underbanked. It's 5 billion people. Another interesting factor is 70% of all land rights globally
are not filed in a public register. For example, if you're a farmer in Afghanistan, you might live on your farm since the last 30 or 40 years, but you will never be able to get a loan on your piece of land since you can't prove it if it's yours. Or if you're living in a dictatorial regime, someone could easily come and take your land away. Due to the immutability of, for example, the Bitcoin blockchain, we could think of a global property register that would enable this farmer in Afghanistan to get a loan on his property. Also remittances. Globally, $600 billion are on a yearly basis remitted via Western Union and Union Bay at a staggering 12% transfer rate. You couldn't think of Credit Suisse doing that to us, 12%. Frankly speaking, these three use cases are mainly emerging or developing countries' use cases. But that's why I think Bitcoin will definitely survive. But also, if you're looking in our industrialized world, we could think of ensuring compensation for creators of value. From 100,000 streams of a random song on Spotify, the artist gets 180 Swiss francs, with most of the value going to Spotify. We could think of a world where we have smart contracts powered by Bitcoin, where consumers of music could directly peer-to-peer pay the artist without an intermediary. We could also think of recapturing our digital identities, the breadcrumbs we are living when surfing the internet. Google made last year 111 billion US dollars in revenue. Most of it being attributed to selling our data to ad agencies. We could think of recapturing this data and to decide where we want to sell it and to whom we want to sell it. We also could think of a true sharing economy where cars are not only driving themselves, but they are owning themselves. They would collect data while they're driving, and with the help of smart contracts and digital money, they could sell this data while the car is driving to companies interested in analyzing it. Maybe insurance companies, tire producers. And thereof paying themselves back while we are driving them. What we have seen now is basically, or what I tried to guide you through is basically my belief why Bitcoin will stay. And I think as an investor, the first thing you have to ask yourself is this asset, will this asset stay at all? And that's for me the reasoning why it will. But now let's quickly have a look why Bitcoin is also interesting from a financial investor's perspective. When we went through the technology, or if you look at the patterns, or if you see Bitcoin trading, you can basically see four distinct characteristics. The first one is it has almost no correlation to any other asset class we are currently knowing. It has no correlation to treasuries, no correlation to precious metals, volatility, equity, even currencies. It has basically no correlation. What we traders like is volatility. And you're getting tons of volatility in Bitcoin. If you're looking on January 2018, where Bitcoin had its heights of its price, we saw 8 standard deviations of volatility, compared to a 0.5 standard deviations in a euro dollar, which is usually a classic value for an established, highly stable currency. Even in nowadays time, we are seeing two standard deviations in volatility, although this is the lowest volatile environment we have ever seen in Bitcoin. This market as it's in a very juvenile stage, is also extremely event-driven. It reacts massively to regulatory news or general news in the crypto space. It shows a 91% correlation between Google search terms for crypto-related topics and the underpinning volatility. Even with massively consumer-driven stocks, or the consumer-driven tech stocks, you would only see 50 to 70% in correlation usually. Or event-based topics like ICOs. As Bitcoin and Ether are the predominant funding currencies for ICOs, especially if there's a big ICO happening like the one of EOS, you could literally see the price appreciation of the two currencies as people wanted to buy into those ICOs, followed by a sharp decline in price after the ICO closed, since the project exchanged crypto against fiat to pay their utility bills. If you know that, you can benefit of it. It's basically a fight, stupid against smart money, which is happening here. Also tax events, an example. If you look at the major tax states in Asia and the US, you see sharp drops of Bitcoin and Ether, since people liquidate their crypto positions to pay their taxes. These are patterns we are not seeing anywhere else, besides in crypto. If you're looking on the trading side, also liquidity is a major point. Although the liquidity has gone down significantly, we are still seeing nowadays 4.3 billion US dollars daily volume, which is basically twice the liquidity of Google's Alphabet stock. Although this market seems extremely interesting, it's also quite a risky road. The risk mainly being in the central point of failure, which are exchanges. Usual crypto exchanges are not regulated at all. With PIMS, for example, the biggest one of them, for quite a while they didn't have a postal address where you could send complaints. This central point of failure flows out in basically three major risks you're running if you're trading cryptocurrencies, which is the first is counterparty risk. As your counterparties are not regulated, it can hit you quite hard if you're an investor. With the most prominent example being the bust of Mt. Gox, which took 850,000 Bitcoins, investors' money, with it. If you do the math, it's more than 5 billion US dollars of investor money. But also on the regulatory side, looking at most major countries, their regulatory environment is far away of being set in stone. With only a few countries, in example Liechtenstein, having a first draft of a crypto law in their drawer. What happened to BTC could easily happen to all the other exchanges, simply getting seized by a government. Or we're looking to cyber risks. 8% of all crypto exchanges have been hacked last year. These three risks alone basically make it uninvestable for institutional investors. Since if you're an institutional investor, you're more looking into containing the value than making 100% plus per year. But those risks also can be solved if you play it via classical financial instruments. I want to quickly guide you now what we did as a company and our approach to tame the beast. As an investor, you're always confronted that if you're come in contact with a new asset class, to question yourself, do I want to be invested passively, or do I want to run active strategies on it? The interesting thing is, if you're looking to the crypto market, it is basically flooded with passive index-based vehicles. But even if you look at the Bitcoin market as a stupid banker, what I am, active strategies seem wesently much more attractive. It's only 2 other players in the United States who run active strategies on it, also quite successful. Given the characteristics I described below, I described above, we are running currently trend following strategies coming basically it's established FX trend followers. We are also doing momentum-based strategies on Bitcoin. And we're also doing event-driven strategies on Bitcoin, due to the properties I just presented beforehand. Trend followers have one downside. In cases there are side markets, they usually tend to lose significant amounts of money, although they also earn significant amounts of money in trending markets. To account for that issue, we have built in half a year ago special filters basically that prevent the algorithms from trading as soon as the volatility becomes too low. We also brought them now unwillingly to test in October, which was an extreme side market. And we saw those filters being extremely successful in that environment. But one main question still is unresolved is, if you're an investor, you're also asking yourself, how should I get exposure? Should I go via the physical asset or should I go via derivatives? For us as a company, we clearly vetted against trading on physically for the above given risks and reasons. So we had to look into the derivative space. The product horizon there is quite limited. It's Bitcoin futures we are seeing from CBOE. We are seeing CFDs from normal FX brokers like we are seeing them in an FX market. And we might soon see Bitcoin ETFs with 20 of them or 20 applications for Bitcoin ETFs having been turned down by the SEC. Until we see Bitcoin ETFs, that is at least my belief, we still have to wait a couple of months. We have looked deeply into the futures topic and also vetted against futures for 2 reasons. First, they allow only for 20% volatility per day before trading halts. And they also ask for quite a significant amount of margin. For our fund, we are running currently CFDs, to get exposure long short. CFDs are basically contracts for difference. It's an OTC contract you're entering with an FX broker that pays you the differential between the entry and the exit price. Long short. But as it's an OTC deal, you basically also run into counterparty risk. That was something we wanted to account for. We wanted to build a stable and secure solution. Therefore, we evaluated over 100 brokers, FX brokers on a global scale, on macro aspects like geographic location, years since inception, average daily trading volume, ownership structure. Out of these 100, we identified 32 brokers that passed that round, where we got in direct contact with. We had meetings, calls with them, and also asked them to fill out 67-question due diligence questionnaire containing questions to their storage of crypto, their treatment of accounts, segregation of accounts, and more detailed questions also trading related. Out of the 32, we just identified 3. something that wouldn't be unthinkable in an FX environment. The funny thing, all those 100 claim you can trade CFDs, crypto on their platforms, but basically, if you're coming with institutional money, you can't. We are going through an environment that currently has a lot of question marks, and therefore also the product horizon is fairly limited. Which doesn't mean it is not interesting to trade. But what risks does it actually solve to go via CFDs and not buy into the physical asset? It basically solves all the risks. Now our counterparties have a banking license and are not some random crypto exchange with no postal address. Also, cryptocurrencies for an FX broker is only a fraction of their usual business activity. So on counterparty risk side, it basically solves all your problems. Also on the execution side, as the market is highly inefficient still, we are like equities in the 70s. You're having enormous arbitrage opportunities. That's also something what we are intensively looking into with our hedge fund. But if it's really about trading, you don't want inefficiencies. Our FX brokers naturally have to apply to MiFID II. Therefore, we also get best execution on our crypto positions, something you won't see on physical exchanges. We don't run cyber risks, we don't run storage risk. We know basically how to DEX CFDs, something in some jurisdictions is still that there is an iteration going on. Also on the regulatory risk side, CFDs are structures present in the market since the last 20 years, so no question marks about there. Also from a flow perspective, we are trading basically on old FX infrastructure that is well tested. For example, what we are seeing on crypto exchanges is double executions. No execution, although trade confirmation. Those exchanges get better, but if you're coming with institutional money, that's definitely not a way you want to go. Just to quickly recap on how we look at the market, we strongly believe active strategies are at this stage of the market the only way to go. We also strongly believe that as an institutional investor, you shouldn't go down the physical path. We are going via old, established, traditional routes. That's from our perspective the most secure way of crypto investing. Thank you very much for your attention.